All right, folks, inflation numbers came in today and it was a little bit of a shock. It was a shock for people who were, reading it maybe the wrong way. And I think the market is reading it the wrong way because I'm going to go over with you two main reasons why this CPI data, it's a little bit of, an overreaction because of some things we've been discussing for the last couple of weeks here, and why I think this is setting up the stage for stocks to continue to start rallying again based off of these overreaction, and see exactly how you can position yourself in specific sectors or stocks in order to make a little bit of money as we get into the correction happening very soon here. So inflation came in and 8.3%. So 8.3% was comparing to last August. So if you look at inflation, or prices last August 2021 and August 2022, prices rose 8.3%, which when you compare from the month of July, it's just a slight uptick of 0.1%, just a 0.1% uptick. Now, that 0.1% uptick, I believe, is what is carrying people off. Why? Because they're thinking inflation has not come back down, which is true, but not true. And because of that, people are taking money off the table because they were anticipating that we'll get maybe a 0.5% decrease compared to the month of July, but we did not. Now, the first reason why I think this is a little bit of an, misconception is because when you look at the price of oil for the month of August, the price of oil is down 21%. If you look at the price of houses, the price of houses is also down significantly. All right? But you don't have that in the CPI calculation because of the way this statistic, because the CPI is a statistic. It's a statistic, and because it's a calculation, it's something that is being calculated depending regarding maybe the formula, maybe the input, maybe the range of the data. And I think there is a difference. There is a difference between what is actually being, released officially and what is actually the reality on the ground, on the terrain. And I'm not the only one thinking this. Kathy Wood is thinking this. A bunch of other, way smarter people than me are also thinking the exact same thing. Wharton professor Jeremy Spiegel, says the exact same thing. He says the stock market will surprise investors to the upside as cooling on the ground inflation means the Fed won't hike rates to the extremes. Look, this is something I've been saying for the last 3 weeks now. There is a difference between looking at the price rise in the terrain in the real-time data. Like, if I go to the grocery store, if I go to the pump, I'm seeing the price I'm paying, the bill has decreased from the month of July. So real-time data, things are a little bit disconnected from the statistics or the data that we're getting from the economy. And because these are 1 month lagging, and that's why I think, people are looking at this and thinking, well, the Federal Reserve might go and be, have the green light to pretty much do another jumbo interest rate hike, maybe 1%. That will be 100 basis points. But the thing is, even if they do that, there is a risk of that overdue, on the rate hikes can cause unemployment to rise to 5%. This is Bank of America saying, this is not me, this is Bank of America. Now, because the Federal Reserve is looking at a decrease, or the job market to cool off, they might read this whole thing a little bit, halfway. And that is why I think if you look exactly at what is going on today, it means that by reading in between the lines, there might be a pretty good upside on a quick correction coming up because people realize that, wait a minute, when the Fed meet in September, the Fed is also looking on these numbers. And because you're looking, they might say, you know what? Even though the CPI for the month of August has not seen a decrease as we're expecting, the real-time data for the month of September shows a different story. Tell a different story. Again, house prices have been dropping significantly, but you don't see that on the CPI properly reflected. The price of oil has been dropping, but it doesn't seem as if it's getting a lot of weight into the CPI also dropping, So based on this, I think when the Fed meets at the end of September, If they go 75, which I think they will do, or maybe they have high chances of doing 50 and then 25 again, but people are now trying to price the fact that the Fed might do 100 basis points, so increasing interest rates all the way up to 1%. But if they don't do that, which I don't think they will do because they had many chances to do so in the past when inflation was still very high and they didn't. So once they do that, people will start, having a relief that they didn't go to the extreme, but stick with at least 75 or 0.75%, which will cause the market to, go up again, or stocks to go up again. Now, if you look at today, this was the worst day on the market since June 2020. And remember, 2020 was the COVID year. So the Dow Jones lost pretty much 1,300 points today. But look at what the only maybe sector that didn't, budge much was the oil. If you look at oil, it barely, got impacted. As a matter of fact, we closed 0.5%. 0.5%. That's the price of oil today. So this gives me, it confirms my theory that, energy sector or energy stocks are in a buy zone right now. And if you want to make some money going into the year end, definitely you want to get in now, especially as, the market cools off, inflation continues to cool off, and people realize that, what, maybe we were overreacting and it's time to make money now. So these are my 2 cents, and we'll see exactly how it goes for the next coming months. But yeah, until then, be careful around this coming Friday, because we do have, option closing day, what we call quadruple witching, and we also have, the Fed meeting at the end of the month. So 2 major events that may, prevent the market to, rise up as, it was expecting, or I'm expecting it to do, just because these are, negative catalysts, or could be negative catalysts.